Okay, now you are live.
Hello. Hi, can everybody hear me? Hi, it's Stuart here from HotForex. I hope you can hear me. I'm not sure if my speaker's working, so let me just check. So if you can hear me, I'll obviously put some notes in the message box. I hope you can. Sound is fine. Great. Okay. So my name's Stuart. I'm the market analyst here at HotForex, and today we're going to run through our live analysis, how some of the things we teach people here at HotForex about how to take trades or take positions, and I'll briefly run through multi-time frame analysis before we look at some live charts. So if anybody's got any charts you'd like me to have a look at, put some questions in the questions box, and I'll see if we can get around to those later on. Okay, so let's crack on without further ado. So any problems, obviously, at the end, if you don't understand anything, obviously you can email me directly at webinars@hotforex.com or via our host here today, FX Street. My name's Stuart Cowell. I've been involved in trading for over best part, well, since 1997, as you can see there. My background is in the City of London, and I've been trading, investing since 1997. Four things I would say I've sort of learned over the time. It's to do what's probable, keep it simple, look at multi-time frame analysis, but most importantly is to know yourself. If you don't know yourself, you're never going to be a successful trader. So what sort of person you are, what sort of risk profile you're prepared to accept, and once you get your head around that, then you can move forward. You can move off first base, really. Okay. That's what we got over there. So I'm sharing the right screen here. It doesn't matter. Just get my notes as well. So that's our quick disclaimer. I won't read it out. Obviously, this is for general marketing purposes. The information comes from reputable sources, and obviously there's a certain degree of risk and uncertainty when you're investing in Forex and CFD products. Okay, so this is purely a communication for education, and we would not like this to be reproduced or further distributed without our prior written permission. Okay, so before we get going, this is what we're going to run through today. I'll go through multi-time frame analysis quite quickly. So if anyone's got any questions, put that in. But I say I'll run through it quite quickly. There's whole webinars that I run and others run for multi-time frame analysis. So that's just one of the things that we teach here. Obviously, it's been a very important week for news, and I'll run through the key news items and a key week coming up as well ahead of us after tomorrow's big news. Some of the trades we've taken this week and why we've taken them, particularly on the yen. Some are in the money, some are out the money. That's trading. That's the way it goes. Some others we've taken in the last couple of days. The New Zealand dollar has been of particular interest. And commodities, oil and gold. Everybody likes to look at gold, and I will look at some stocks and the stock markets and why they continue to grind forward or move forward. Okay, so and any questions, obviously. So fire in questions into the question box, and I'll answer them as well as I can. Okay, so. Multi-time frame analysis is what we teach as our approach. It's like any approach, it's not infallible, and I say most of successful trading is what's between your ears. It's really about your approach to risk and managing risk. Just a point, I can have a tendency to speak too quickly. So if I'm speaking too quickly and you can't hear me or you don't understand what I'm saying, please ask me to slow down. Okay, so multi-time frame analysis, looking at, as it says, multiple time frames, at least two, possibly three. Some people call it resolutions as well as time frames. So we're looking at the dominant time frame the higher time frame and looking for entries on the lower time frame. Sounds quite straightforward, and it is. If you can, follow the rules, it's very straightforward. Okay, it's very much a top-down approach. Helps you to focus on the dominant trend, trail with the prevailing momentum, because that's what it's all about. It's all about momentum. Why fight something? I was born in a small village in the north of England, on the coast, and the tide came in and went out every single day, and there were some big waves and little waves. And trading is very much like the ocean. It never stops. Waves on the ocean never stop. The wind blows across the top of the ocean, creates waves, and they keep going. And as traders, we're always looking for that, the key wave or the key opportunity, and that's all. So don't waste your time and energy trying to swim against the tide or fight a big wave. Go with the flow, go with the momentum, identify the momentum, and surf it into the beach, to finish my analogy with the beach. But I'll talk about waves quite a lot. It's just where I was brought up, and I live here on the coast here in sunny Cyprus as well. So higher time frame, sometimes 3 time frames. Support and resistance, very, very important, very straightforward. Smallest time frame for entry, higher time frame for marking these resistance and support areas. Okay, so it's very straightforward. Price points, pivot high. Pivot highs are historical turning points in price. So like any market, the financial markets, it's all driven by supply and demand. Once demand exceeds supply, the price moves higher. Once we get to a balance point, we roll over, and supply exceeds demand, the price starts to move down. And it's as simple as that. As I said at the beginning, I try to keep things simple. So don't complicate things too much. Don't overthink things too much. And the beauty of technical analysis, and the beauty of candles patterns in particular, is it can be very, very simple to understand. Put the right colors on your chart, and again, it becomes even simpler. So here we've got candles moving up. We've got higher highs, and then we've got to the top. We've run out of energy. We've got this high wick, and our fourth candle has rolled over. So we've closed here, but the fourth candle is closed here. So we're down, we're below our previous high. So we've got our highs lower than the middle high, the top high. And then the fifth candle confirms this five candle pattern. So we have this pivot high where it's created where the previous candles either side are lower than the pinnacle candle. So we have lower highs either side of our pivot high. And to identify that on a chart, it can be quite straightforward, or because they can, they jump out of you, especially if you've got these key moves and these key wicks that appear. So it's, it can be that straightforward. So pivot highs and support and resistance levels in an uptrend. So here we've got, say, the daily uptrend, whatever this uptrend is, whether it's a monthly chart or a weekly chart or even a daily chart. So we've got support and resistance levels being created by these pivot highs. So going back to my analogy about the waves, we've got this first big wave going up. We hit a point here, and then we roll over and we down. So the big wave runs up into the beach, and the backwash rushes back out, and we end up back here. So we've hit this point here, we've rolled over, we've created a pivot high here. Next wave is even bigger than the first one, so it breaks up through what was our previous resistance level, and we created a new pivot high, and the backwash takes us back here. So here we got a trend developing here, because the backwash has broken the previous resistance level, but not by very much. And then the third wave breaks up back through it again. So what was resistance could now become in support, because the points we've hit here on the higher time frame have confirmed the trend, because we've had these 2 points hit here. So the third wave goes up, not as big as the first and second wave, little bit of backwash again, but it doesn't go back as far as this what is now support level. So fourth wave breaks up above our previous high, and on we go. So the trend is being formed here, and now we have 1, 2, 3, 4 hits on our higher time frame in the lower time frame. So the pivot high is created at the top, and these pivot lows are created down at the bottom. as we hit the higher time frame. So resistance becoming support, resistance becoming support. The red line changes to a blue line as we move up in the trend. So we've identified a clear trend there, touching this trend line 4 times, and that's all we're looking for. It's great when markets are trending, but obviously markets don't trend all the time, 20 to 30% of the time. So, and again, charts help you identify these patterns and these destinations and these trends, and is it a trend or is it not a trend? Pivot low it's just the opposite. Okay, so we've got here with pivot lows, we've got the market moving down, supply greater than demand, buyers come in at this bottom at the end of the third candle, the sellers are exhausted, no price won't go any lower, so the third, fourth candle moves us back up, fifth candle moves us back up again. So just like with a pivot high, we had higher lows, lower highs. Here we've got higher lows from the pivot low. So the candle 5 has created our pivot low. Lots of energy coming down, no more energy to take it any lower. Buyers come in and move the price back up. Okay, so either side of the pivot low, we've got these higher lows created by the candles either side. And so we go on. So in a downtrend, just like in an uptrend, we've got the same scenario going on. We have our wave moving down. We hit what is now resistance, and we bounce back up. Second wave down breaks through this resistance and creates a new resistance down here. And now what was resistance coming down now becomes support for our movement down. Excuse me. Okay, so it's the same principle. The higher time frame has created this downtrend we've identified, and we're looking for entries on the lower time frames to take these moves in for these pivot moves. So we're pretty confident as this wave moves back up here that at this point, well, we're not pretty confident at this point, I suppose it could go either way, but here we're looking for it to move back down this way. So we take our short position as we identify this pivot high here. So we're looking to go down here as we break this sort of resistance level here, and we move down again, a little bit of a backwash, another big wave, and we break this resistance level here this time, and we're moving down. So now our downtrend has been confirmed. It's been hit 3 times in the higher time frame, on the lower time frame, and fourth time we have the same situation here where this resistance level here has been penetrated, and it becomes support for our next move down. So we know it's not going to move any higher than that. We get our little pivot high here. The move up has been rejected at this resistance level, and now we're moving back down onto the next level. So here again, we've got a strong downtrend. 1, 2, 3, 4 times it's been touched on the trend line, and we wash our way down, as we say. We wave our way down, or we zigzag our way down. Movement, backwash, movement, backwash, big wave, backwash, big wave, backwash. As we move down, we zigzag down, confirming our downward trend. Okay, so I think I've got the wrong screen on here, haven't I? But never mind. Okay, so in uptrends, when the price pulls back to a former high, we're looking to buy the close to the level of this pivot. So we look for intraday signals. And in downtrends, when price retraces back to a former daily high, pivot low, we're looking to sell into the level of the pivot. We're looking for lower time frames as we're going down. Okay, so on the intraday chart, let's just have a look at it again. Let's run it through quite quickly again. So here we've got our daily trend. The intraday is hitting the trend. So we have the same scenario I've just been talking about. So we go up, resistance, bounce, retrace, next one, back through that resistance. So what was resistance is now coming support, confirmed by our higher time frame. So the intraday, whether it's 15-minute, 1 hour, 4 hours, is confirming our movement. So price pulls back to support, identified in the daily chart, and we move on again. These moves are sometimes reversed at pivot points, but often these reversals happen below the absolute. So, as I say, this is an idealized chart. You know, there's a few pips either way, and you've got to use a certain bit of a nous when you're looking at your chart to appreciate what's going on there. Okay, so we're moving up. We've got our pivot low here at the daily resistance. And so this is giving us confirmation to go back up as it's broken this level here. Next step up. Keeps us going. So we've had our 1, 2, 3, fourth leg up now. We've come back to the daily trend 3 times now. And the fourth one confirms us up. So off we go again. This breaks above the previous resistance and we're off and running. So lots of energy moving this forward. The retrace takes us back to where we were at our previous high, but breaks it or comes to it or it's close to it, doesn't break it sufficiently enough, touches it rather than breaks it. I call it sometimes a breach and broken before it breaks down. But here we've had a touch. It hasn't been breached, hasn't been broken. So we're confirming the uptrend still. And off we go again. We bounce off that key daily level on one of the charts that we identifying the intraday patterns on our candles, whether that's be 4 hour, 1 hour, or 15 minutes. Okay, so this is just a real life example taken from way back. It's 2014 when we put this. But so here we have the dollar CAD in a strong uptrend on the daily and weekly time frames. So here we've got covering from a 6-7 week period from the excuse me, end of October through to the beginning of December. We've identified a strong uptrend, and we have a pivot high here at 114.28. This area here, 114.28 in green, 114.28, which happened to coincide as well from a technical point of view nicely with our 23% Fibonacci retracement. I'll talk about Fibonacci's today, but so there's whole webinars on Fibonacci's, and in fact I'm doing one I think next week on one of our sites about Fibonacci's. So additionally, we've also identified a triangle, and when trading with triangles, the technical theory is that the width of the triangle points to a potential high, and that's what we've got here. We've got our target of 115.44 created from this triangle if we break out of the triangle, and that's what we've got here. So this distance here has created our target from the breakout, which is here. So that's created our target of 15.44. So the question is, that's on our daily time frame. So the question is when to get in, when's a good time to take that. So we're looking for corrections to the support level back to here. So we're looking, as this is running up, we're looking for a bit of a retrace to get us in on the intraday charts. So what are the intraday charts showing us? So here we've got the same, excuse me, we've got the same target. We've got the target at 115.44, and we're looking for a retrace back to here. So here down at the 240 level, the 4 hour chart, we were looking for a retrace, and you can just eyeballing it, you can see there's clear attempt to break through the 23.6 Fibonacci level and even get to the 38.2. So that's a very strong, clear rejection of that movement down. Great big long wick to the bottom. Nice candle formation there, which would have got us in here at this level, and that's this is what's happened. So we've run up, it's retraced, it almost touched, got as far as the 38.22, but you can see here we got two Bollinger Bands set up on this particular chart, 2 deviations and 1.5 standard deviations, and the 1.5 standard deviation provided that support. So at the conclusion of this candle, we bought here, and off we went through target, and then it kept going as well. And that was confirmed by this nice little confirmation in the lower time frame as well, creating this pivot low. So we've got a big indicator we know the strong daily trend. We've returned to it on the 4 hour chart, drilled down to the 1 hour or the 15 minute, and you see this pattern here developing, and that's a great indicator for getting in at this point here. Nice little hammer candle there, and a really strong hammer candle there, and that's what's happened. Okay, so target hit, and we moved up we can pull these examples up all the time. And so it is with going short as well. It's exactly the same theory. I won't run through this as well because I'd like to spend the rest of the webinar talking about the live analysis we've done this week and some trades we can take, and any questions you might have about any charts, any instruments you'd like me to have a look at, if anybody's interested in looking at particular currency pairs. So it's exactly with a lot of technical analysis, you just reverse the situation for short or long positions, and that's all you do here. Many traders speak to me and tell me they somehow they find it more difficult to short a market than buy a market, and sometimes that can be just due to the mindset, and that it's easier to understand things going up than things going down. But the beauty of trading Forex is that it is available 24 hours a day, 5 days a week, and it doesn't matter whether you can make a return, whether you're going up or going down. The old adage of buying shares and holding them, that you only make money with your shares if you hold shares if they go up in price. Going down in price doesn't help you, does it? So that might be the hangover from that. But short entries just the same as buying. And on the flip side of that, I have many clients that say they actually make more in shorting positions than in buying positions. So it's very much success in trading. It's very much down to you. It's very much down to your mindset, your acceptance of risk in particular, and being disciplined and being patient. All these technical indicators, all the services that are offered by all the brokers, they count for nothing if you haven't got the right mindset to be successful. And you need to find trading that fits in with your lifestyle, that fits around what you're doing, and that fits your personality. I've never really been a scalper. It doesn't fit my personality. I'm very much a day chart guy. I look at my charts at the end of the day, see if there's an opportunity. If there is, we take it. If there isn't, I don't. During the day, obviously, I'm looking at shorter intraday positions, but that's very much my personality. I check 30, 40 cross pairs every night, and say at the end of the day, if there's something's happened, there's a position to be taken, I'll make a decision and take it or not take it. I know my risk profile, I know my account size, I know how to trade lot sizes, and that's all those basics you need to really understand before you can move really forward with trading, regardless of anything anybody teaches you or anybody tells you out here on the World Wide Web. So multi-time frame analysis is one type of technical EMEA. That's EMEA's just said here, not in my case, unfortunately. My personality is I win over long positions. Okay, well that's fine, EMEA. It's each of us to our own. And we know, again, just getting off track a little bit here, but I have many people that find it easy to trade certain currencies than other currencies. Some people like to stick to gold and oil. They're very, very popular, and few people stick to that. I trade nearly 40. I look at 40 different charts. Other people will just look at 2 or 3 currency pairs or 2 or 3 assets. Or it's up to it's what works for you. And if you have a plan, you stick to your plan, you manage your risk, which is by far the most important thing when you're trading, risk management and money management. You can be successful doing this. And there's millions and millions of people trading online all around the world. So anyway, I digress, which I have a habit of. So I apologize about that, guys. So the down movement is exactly the same. I won't go through it in great detail. This is just an example from the S&P 500, the world's most important stock exchange. It was again, this is from 2014 when we first put these charts together. But we could bring this up any day. So principles exactly the same. Looking for a retracement, looking for the support in the higher time frame, looking for intraday entries on the lower time frame, 1 hour, 4 hour, 15 minutes, 30 minutes, whatever it is, and away you go. It's can be quite straightforward. So let me just go back to the summaries. So when we're buying in uptrends, you're looking for price to pull back to a support level identified in the higher time frame. Momentum reversal signals, such as the good old hammer candles, appears in the lower time frame. So if we're looking at the daily, the 4 hour, 1 hour, or 15-minute time frames, and close by the close of that particular candle. So if you've identified it on the 50, you've had to drill down to the 15 minutes. You wait till the candle closes. You've got to wait till the candle close, whatever trading you're taking. Many times I've been sat waiting for my daily candles to close, and this is, because I've been doing this for many years, I've been caught out. I've jumped in before the close of the candle on that particular day, and been burnt a few times doing that. Cedric, how many trades per day do you recommend? Well, it depends. It depends if they fit your time frames, if they fit your trading plan. You need a trading plan as well, Cedric. You've got to decide why you are doing this. There's no point jumping in and saying, well, I'm going to make money. I want to make money. That's not good enough. You need to sit down, write a trading plan about why you're doing this. Do you want to make money? Are you saving up for a home? Do you want to buy a new car? Do you want to send your children to university? Do you want to get married? Have some goals, stick them next to your trading platform, and write a trading plan that fits that. But don't trade, don't sit in front of the screen saying, right, it's Friday afternoon, I'm going to trade today because I've got 2 hours to trade, and go looking for trades. It doesn't work like that. Just because you want to trade then doesn't mean that a trade is going to come along that fits your approach. Okay? So you need to find an approach that works for you, fits around, as I say, I repeat this many times, and I won't apologize for that because it's quite important, that fits around your lifestyle and your personality. Some of the best traders that I know are people that work shifts. People in risky jobs that work shifts and make the best traders, because it's all about managing risk. So one of the best traders I know is a lady that's retired. She used to be a camera woman for the BBC, and she's very, very ruthless. She's very cold. She's a very pleasant lady, but as a trader, she's very cold and ruthless and mechanical. She doesn't use EAs or any robots or anything. She just has a very good knack of looking at a chart and making a decision very quickly. And that's where you want to get to. If it feels right, do it. If it doesn't, don't, because there's many, many, many trades and opportunities all the time, Cedric. So don't try and set yourself trades per day. What you want to do is manage your risk. Regardless of how big your account is, I would, again, I can't recommend or tell you what to do, because I can't do that sort of thing. But if you're only risking 1% of your account on a trade, if it goes wrong and you lose 1%, that should be okay. It shouldn't bother you. If it bothers you, don't trade. Go and do something else. If you're only going to lose 1-2% of your account on a trade when it goes wrong, and you write it down why it went wrong, and you analyze it afterwards, you've learned something. Put it down to learn experience. And if you can stick to that, you'll be amazed at how quickly you can, improve your account. You don't need to get all your trades right. You don't need to get, even 50-60% of your trades right. With strict risk management, the numbers say you can double your money in a year, or in over a certain number of trades. It's quite straightforward. But you've got to manage your risk. You've got to manage stop loss and take profits, and not get emotionally attached to a position. If it goes wrong, it goes wrong. I'm very much, because I trade off daily charts, I'm not interested in what's going on during the day. So I put my trade on, set it and forget it, I call it, or lots of people call it, it's my original phrase, but put it on, forget about it. Set my stop loss, set my target. If it hits the target, fantastic. If it hits the stop loss, never mind. Because I know it's only going to be 1% of my account, or a little bit more of my account if I lose it. But I also know if it hits the target, it's going to win 1.5% or 1.8% of my account. So, and if I'm winning 60% of my trade, 6 out of 10, I'm in the money. And what I do here at HotForex, we post analysis on our website free of charge. Anybody, you don't even need an account with us to read our analysis. But if you add up all the analysis we've done in the last 3 months, we're on a 70% hit rate, hitting our targets. And if you can approach that, if you've got a 70% hit rate, manage your risk. It's very, very straightforward business. Don't overcomplicate it. Too many people overcomplicate this business, or come into it trying to make money, wanting to make money, and it's take that mindset away, and you you can make great strides forward. Anyway, yeah, again, I get off track and off. So we're already 30 minutes in. So let me just rush through. So in the downtrend, just like in the uptrend, it's the same thing. We're looking for pullbacks to resistance at the higher time frame. Entries on the lower time frames, such as a shooting star in a downtrend. Some other candle patterns here. We got lots of energy here, running out. Can't get it any higher. We're running out of energy. We're rolling over. Classic, green and then red. That's our great signal there. Out at the top of the Bollinger Bands. Great signal there. Even on this 60-minute time frame, 15-minute time, even tighter. Perfect little setups. And away we go. Very confident about that position. Obviously, they don't happen all the time. They don't always win. But that's, again, part of trading. If you know you're only going to lose 1%, doesn't matter. Get on to the next one. Write it down. Have a trading journal. That's one thing I learned after the first few years, writing everything down. And it was amazing how much detail was in there, just from some scribbled notes as they started off. But you find a pattern that works for you. You find the time frame that works for you. You find the currency pairs that work for you, or the assets that work for you. You find the time frames in your lifestyle that works for you. I'm a morning person and a late night person. During the day, I'd like to have a sleep in the afternoon, and that's partly living in Cyprus. It gets too hot, so you adapt to your environment. And you adapt to the sessions as well. Yeah, everybody says the UK and America session is the key. That's the deepest liquidity, and yes, it is. But you can trade at other times. You don't just need to trade those key sessions. And so, as a day trader or trading day candles, that doesn't affect me. As a scalper, you'd want to be in at those sessions. You want to be at your screen. Very lots of trades in and out. Few minutes, thank you very much, pips here, pips there, and off we go. But still the same approach about risk and knowing yourself. So anyway, let's get on to what's been going on this week. Really important week. Brexit. Everybody's been talking about Brexit. I'm British and I'm bored with it, so heaven knows what the rest of the world thinks about it. This is all my personal view. This isn't HotForex's view or even FX Street's view. This is my personal view about the markets from the knowledge I've gained over many years of looking at this. But in my view, the Brexit honeymoon period, I think, is really over now for the Brexiteers. The real data that's coming out of the UK is now beginning to bite, and I think the UK is heading for a recession, certainly a very quick slowdown. Lots and lots of fundamental news this week. So I put these in order earlier in the week. For me, the most important data release for this week is tomorrow, the overnight, the Bank of Japan issuing their statement, and definitely from what they said yesterday, lots of more stimulus. What does that mean? Well, it means that the Japanese economy is moribund. They can't get it going. Abenomics isn't working, so he's talking about chucking trillions of yen into the market, 7 or 8 trillion new money. Lots of it already been announced, but 28 trillion yen tomorrow. So we'll see what comes out. A big impact, obviously, on the Japanese yen and all its near neighbours, like the Aussie dollar and New Zealand dollar. Anyway, that's tomorrow. So the result, the stocks will probably grind up and the yen will probably go down, but we'll see what actually happens. Yesterday's Fed announcement, a bit of a no surprise, a bit of a no-brainer. The dollar weakened immediately following it. They have 3 more meetings this year: September, November, December. September is possibly still on the cards. I don't think so. November, they won't do anything because it's a week before the election, the United States presidential election. So they're unlikely to do anything then. So December possibly, but again, I've put hum here. So very dovish. There's only one hawk on the board, Esther, not Esther Williams. I've forgotten the second name. No, Esther. She's the main hawk on the FOMC, so Yellen's very unlikely to move even in December, in my view. But anyway, let's see what happens tomorrow. Again, US gross domestic product. Any other week, this would have been the #1 piece of information. Gross domestic product. How is the country doing? It's not a perfect measure, but it's the best we've got. Estimates from 2.4 to 2.7%. I'm at the low end of this, 2.4, 2.5% expected. Key data point, key impact on the dollar and all the other resounding currencies. Also tomorrow, we got this stress test later on, the European banks test. The Italian banks very, very much in focus. This could be, a tipping point moment, bail in or bail out of the Italian banks. What's going to happen there? Also, this week we've got earnings season in full flow. Second quarter earnings out of the States, Europe in particular, and say the US in particular. So we've had some big hitters out this week. Facebook, smashed it last night. Record profits, record high for the share price. This new live app they've got seems to be doing very, very well. Apple off its knees, a big gap up in the Apple chart the other day. BP and Shell under lots of stress. BP, British Petroleum, big oil refiners. Shell announced today 72% drop in profits. So lots and lots of data for the market to absorb on top of all these other issues as well. Lots and lots going on. Deutsche Bank way down. Profits were only 20 million euros for the quarter, compared to 276 million. I think this quarter last year. Very under pressure. And again, Deutsche Bank could be. The reason I put Deutsche Bank on there is that a couple of years ago they were the most forex trades went through Deutsche Bank. They were the key #1 forex trading bank, and now they're under lots and lots of pressure. And again, it could be a bit of a tipping point if something happens with Deutsche Bank going forward. Deals this week, Verizon, old stable telecom stock, yields 4%, very nice. Thank you very much. When there's negative yields and on bonds and other assets, but buy a few Verizon shares and they'll give you 4% every year as well. Gobbled up Yahoo, one of the original internet companies, $5 billion deal. Small cash for Verizon, a $200 billion company. So lots of merging acquisitions. That adds confidence to the market. That adds that positivity as the stock markets are grinding up. But in my view, stock markets are only grinding up because it's the only game in town. Investors can't get a return anywhere else. There's negative interest rates in the banks. There's negative interest rates on the yields. The yields are negative all over the world. And so where do investors get money? Well, it was stocks, but they're getting very, very highly valued stocks. So it looks like they might be slowing down as well. Other news this week, we've had inflation out of Australia. The Aussie dollar has sort of bounced around a bit on that. Real problems with inflation all around the world. This time last year, we were talking about deflation being exported from places like China and Japan, and it's just not picking up. And finally, tomorrow, again, the good old Eurozone also got inflation and gross domestic product. So massive news this week. Lots of significant pieces of news. Also, it's the last day of the month tomorrow, Friday. Lots of squaring off of positions. It's not only the last day of the month, it's the last day of July. So lots of people will be going off on holiday, investors squaring off their positions. So might be some strange moves today and for the rest of the day and tomorrow. But with all this data hanging around, lots of potential volatility. Volatility is good for us as traders, but you got to trade with caution and trade with good risk management, and you're okay. So this is tomorrow. So Bank of Japan overnight in the morning, our time here in Cyprus. These times are GMT here downside. Gross domestic product out of Europe is next. Then it's gross domestic product later on from the States. And then other personal consumption is quite significant. That's a preliminary figure. Preliminary figures are always the most important, and because they're the first indication of where we are. And then later in the day, the announcement of the bank test, the bank stress test in Europe. So lots and lots of news. And then as we move forward into the new month, next week, it's very, very interesting again. We got ISM figures, PMI manufacturing figures from the States on Monday. We've got 2 rate decisions, one from the Reserve Bank of Australia, Possibly they could move on Tuesday. And then we've got the Bank of England, which said they were going to move in the summer. He didn't do anything in July, so it's nailed on, it's priced in that he's going to do, I'm saying Mr. Carney and his colleagues may do something on, will definitely do something on Thursday, in my view. Possibly a rate cut, possibly more QE as well, or both, quite possible as well. So we'll see how we go. And, Mr. Carney's very, very suave, very smooth, but again, hang on every word of what he says on his speech later on Thursday. And then Friday, it's non-farm payroll as well, just around the week off. So very, very interesting week ahead, a few days ahead on the fundamental side. I'm a technician as well, but fundamentals, you cannot ignore them. Many technicians say, the news is all built into the charts and you don't need to follow the news. But news like this, news like we've had over these last 2 weeks, is very, very important, and the markets hang on every piece of information that comes out there. So it is quite important to follow that as well. Okay, so let's crack on. We've got about 20 minutes left. So let me just run through some of the trades we've looked at this week and the approach I've taken both on multi-time frame and simple moving averages, and taking the fundamental news into account. Okay, so we've had a look at the yen, the dollar, oil, gold, some stocks, and we'll bring up Apple as well. So the yen pairs are on earlier in the week on Tuesday. We looked at these, and this looked really, these key support levels here couldn't break. So we've had 1, 2, 3, 5, 6 days of hanging on to this level here below this big spike down on the Brexit day. So on Tuesday 25th we went short as this was broken. Ideally, from my point of view, this chart shows us the red line is the 50-day moving average. It's the daily chart of the pound yen. 50-day moving average, Bollinger Bands with 2 deviations. Central green line is the 20-day moving average. So ideally, I would like to have entered that on the close of this candle below this. It breached and broken this 20-day moving average. But we got in earlier, just on the Monday here at 138.77, I think is what we got out. Target wise, when you're setting targets, I quite like the daily or the average truth range or the daily true range, or the bottom of the Bollinger Bands. The Bollinger Bands here were going sideways, so it wasn't necessarily that was a negative factor for taking the trade. And I say it hadn't closed below the 20-day moving average, but we some dollars up, and we got in here, and we've got our target down here based on the average daily range, about 134, I think it is, and that one's going okay. Okay, so we were exposed ourselves to the yen. And so reduced our lot size, because a movement in yen will affect all of the 4 trades that we've taken. One that closed very quickly on with the same principle was the CAD yen. We got in here again as the break of this support level here. So we see we got 1, 2, 3, 4, 5, 6 days, didn't break this level. Bollinger Bands going sideways again, which is a negative. But we were below the 20, that's 50-day here, the red line. Again, ideally, we would have liked to break through the 20-day, but we had our target down here based on the ATR, the average, the 14 ATR, that's the 2-week one. So 14 days means the big movement on Brexit day doesn't impact our figure here. So we worked the target out here. We had our stop up here at the top of the risk reward is about 1, a little bit less than 1, wasn't it, on that one, but really I was quite confident of that, so we could have brought our stop loss down to the top of the candles rather than the top of the wicks. So that one we triggered here, we got out here. That was a nice, that was a simple one, but I triggered before we on the Tuesdays we did it live. And what did we get? We got there we are, 78 pips. So the 8 hours 140, but it already triggered earlier, so we only took 78 points out of that, but that was a quite simple one. The other yen ones we've got were short Aussie yen. This is from earlier today, so again similar sort of principle. We've got the stop back up here. This is on the demo account, so you can see they're actually live trades here. So that could easily be dragged down here if we're going to end up going back up here. We got in here, we're a little bit, a good way in the money yesterday and the day before, but again this principle was the same. See how this level here didn't break for 1, 2, 3, 4, 5, 6, 7, 8 days. Broke it here. We got in here on Tuesday. Got down. Nearly got to our target based on the ATR again. Didn't. It's rejected it. We were out of pocket quite a bit yesterday, and we're sort of still in pocket today here. So that's the Aussie yen. But again, tomorrow, next week, see how long that goes. Remember, it's a daily trade, so set forget. We're in there. The 50-day here is proving quite strong, isn't it? You've got 50 and the 20 there, so that's actually quite a negative for our trade here. We've got both moving averages here supporting, and some dodgy sort of type candles as well. So, but relatively tall wicks here, so perhaps we can go back down. Let's see how that goes. Okay, so any questions, anybody? That's the Aussie yen. We're still in the money there. Next two are sort of out the money at the moment. This is the euro yen. We went short, same principle. But having said that, this was less confident because we had less days. We had 1, 2, 3, 4, 5, 6 days. Where do we get in? We got in here again. Our stops up here. Our targets down here a bit longer than our one-to-one risk. We bounced back again yesterday, and we're a little bit out of the money on that one at the moment. But hey ho, that's how it goes. But that's our exposure with the yen. We're expecting the yen to strengthen, so we'll see how we go during this week. That's what the signals we were getting. We haven't got a trade here on the euro yen, excuse me, but it's obviously one to watch. And yesterday we had this jump up on the Fed. Sorry, jump down on the Fed announcement, and so we're hang around this 105, 106 level, and still between the 20 and the 50-day moving average there. So some sort of compression going on there. So obviously look to lower intradays for entries if you want to trade intraday, or look at the high time frames. When I'm looking at my daily candles, I like to make sure I've got the I'm with the monthly trend. Okay, the weekly I don't really follow, but the strong one is the monthly. If the monthly's in a downtrend, that I tend to try to go with that flow from the daily time frames. Okay, so how long we got? Time we got? So 10 minutes. So let's quickly run through. So this was one we took on Wednesday, and again, it's just a simple. This wasn't particularly a technical trade. This was just something that hit me as a clear. Well, that can't keep going. Sort of it's a common sense trade. I talk about fundamentals and technicals, very important, but sometimes the obvious really jumps off the page at you. And the New Zealand dollar and US dollar had this trade earlier in the week. So here, what background? We've had 1, 2, 3, 4, 5, 6, 7 strong candles, large candles, moving down, smaller as they got down. So again, we're moving down quite strongly day after day. We had this long wick here. We broke through the 20-day, so that would have been, I didn't see that, but that would have been a good short trend as we'd broken strongly down to this level I'd already marked. And previously, this chart's quite an old one. I don't know where those numbers have come from, but you can see how these old levels always get taken back to, or can be traded back to. So 6 movement down, 2 doji candles, questioning where are we, couldn't break through the 50-day. The following day, I think this was Wednesday or Tuesday, 26th Tuesday, it broke back through the 50-day, and we got in here. And we were looking for here, I didn't look at the daily or the ATR on this one. It was more just a gut instinct thing. Having had 6 strong movements down, I was expecting a bit more of a retrace, and that's what. So I looked at like the third top of the candle. So first target was here, second target will be here at the 20-day. So we got in here, and we got a very simple, just little bounce, very simple little trade back to 71.50. 71.15, 16, I think is what we got out. Just because of this strong movement down, the doji is signifying indifference. The long wick on the day before drilled down to the 4 hour and 1 hour, and it gave me the entry on as we bounced up here. There were some hammer candles here on the 1 hour chart. I'll bring that, and in we went for a very simple, stress-free little bounce for some pips all the way back up here. That was the New Zealand dollar, US dollar trade from Wednesday this week. The other one that's caught my eye today in particular is the Swiss franc, dollar Swiss franc. The daily yesterday broke through and breached, well, significantly the 200-day moving average. Remember I was talking about the 200-day moving average as being a clear support level. So again here we've got support for 1, 2, 3, 4, 5, 6 days, broken through today. So we'll see where we finish. The green line we've got here could be our entry. This trade isn't, we haven't run, this trade hasn't broken. Sorry, hasn't triggered. This is a weekly support. So as we may be looking for this, it may get to here and we may bounce back up. Otherwise, you know, we could end up breaking the 20 and going down to the 50 as well. So they're out of kilter. The Bollinger Bands are coming back together here, and so we're looking like we may be going sideways. But this is a weekly support level here, so this looks quite interesting for me as we've broken this 200-day, and we've not only breached it, but we've broken it quite significantly. Okay, it's good to, you know, if you're trading on particularly trading on the daily candles, I like the 20-day. You know, make sure it breaks it properly. So like we got here, this is a good one. Nice clear break. Next day opened a little bit higher, but closed even through the 50-day here. So that was if you hadn't got in that day, that would have been another good day to take it down and hit the bottom of the Bollinger Band before it went sideways again and retraced. Struggled with the 20 again on the daily, jumped right through it, and then the 20 is providing support, and off it went up to the top of the Bollinger Band here. So here it's been quite strong. So again, we were looking, although it's broke the 200 here, probably more significant than the 20 on the short term, we'd like it to sort of be down around this level, this 98.17. So one to watch, it's on my watch list, the dollar Swiss franc. Okay, so 10 minutes to go. So so they're the two trades we've taken. So let's have a look. People always ask about oil and gold. Oil's in this big classic downtrend. Again, on the daily charts, 43 was talked about in the week it broke. This is the one I've been watching. That was the 46 level I thought was a key pivot, and we've gone short here at 46. And this is just, you know, we just added to this trade. It's just a waterfall down as this 46 level broke down. So what we had was a big step down through it earlier in the month. We had a rally back through, but the weakness continued because we see how we're below the 20-day moving average here and quite a good gap away. It's just not got any strength, not got any friends, the oil price. This is WTI, the West Texas Intermediate, the US oil price. Little attempt back at 46 earlier and big down movement. So we got 1, 2, 3, 4, 5, 6, 7. So we could end up back down here at 41. But, you know, following the logic we've had here we've seen this 1, 2, 3, 4, 5, 6 and a bounce back. We could be looking for a bounce back up from this $42 level. So 43 didn't last very long. 42 was broken last night. It traded as low as 41.66 overnight, the US oil. I don't know what it's done during the day, but this is certainly on, you know, we've added to this trade as it's gone down, but we may be looking to close this out. This may be looking a wee bit to overstretch the 200-day moving average down here. But there's nothing at the moment to say buy this one, but we could see quite a strong bounce back. Now then, the oil price is obviously undermining the Canadian dollar, but as it's going down, it's also undermining the grind up that we've had in the stock markets. and I'll come on to that with one of my last slides. Gold, the other key commodity people like to trade. I've stopped out the last gold trade. I'm not actually in a position here. I was looking for, and I still am, to be honest, in the longer term, targets of 1394 and even 1428 later in the year. I think we were long about 1370 or 1360 here. I think we got into the top of this and we were expecting it, but it's obviously fallen down. That's one for the losing banks. We got out at 1340, and it's bounced around quite a lot around this level, this 1326 level, and it broke that and it hung on to the 1320, 1318 level as it's fallen out of favor recently, the gold price as we've gone through July. Yesterday's Fed announcement caused a big knee-jerk reaction in the gold price. It rallied very significantly, rallied over 20 cents, went from 1320 up to 1344 at one point yesterday. So, 1340. So it's back up at this key level. So this is looking, again, as you can see, the 20-day here breaks above this today. That we could be looking to go enter that again and go long on the gold price. So there's the pull to 13 and there's the pull to 1400. So it's in this sort of area at the moment, a bit of consolidation, but this could be attracting people here. If again, depends what happens tomorrow with the yen position. Obviously, the yen and gold have both rallied quite strongly as fear grabbed the market and the worry about Brexit. Ironically, the Swiss franc didn't significantly compared to those two assets, which it normally does. So we could see that trade back on, or we could not. Just wait and see. Let's see what happens to this key 20-day moving average here for the gold price. So that's definitely one to watch, and I'm watching that one quite closely. And finally, the stocks. I'll be honest, this was another trade that was a sort of a gut trade, not necessarily a technical trade. I'm short the UK 100 based on the performance of the VIX in particular, from 6,720. My stop is up here at 680, 6,800, and it, as you can see, I might have gone too early, but it was just a gut thing. It was not particularly a technical analysis thing. It did this. It's done this in 2014, 2015. It's ground high. It's ground through the summer and gone up, and we're in this 7-8 year bull market in stock markets. Logic says, like I said earlier, that the only game in town is stocks. So investors are plowing into stocks. Some of these earning reports for the second quarter earnings have been very good. People investing there because that's the return they're getting. They're not getting any return in bonds. The yields are very, very low and negative. So if you could buy a simple little stock like Verizon, good old performer, standard 4%, really, really good yields when you're getting negative interest or minus percentages in your bank. So that's fueling the stock market rise. But my view is that it's getting overbought, it's getting very expensive, and I can see as it bounced up after the Brexit, particularly the FTSE 100, the fall could be quite severe, and we had quite a strong fall last summer during August, and that was generated by the Chinese situation. I don't anticipate a Chinese situation again, but I can see quite a decent fall. So my target's here at 6,590 and perhaps lower here at 6,450, but I don't think we might get back there. But the reaction will be quite severe. As you can see, the candles are very small. They're running out of energy. They're going up, but not with any great strength. They're not very significant, excuse me. So we're getting these doji candles with a bit of indifference, a bit of balance. We can't go any higher. The Bollinger Bands are suggesting we're starting to go sideways, so we could consolidate here at this level for a while before we roll over, before we go down. But the Bollinger Bands are starting to narrow. We're going sideways. We're entering August. Can be volatile. Volumes are very low. So we'll see. We'll see. I say I've been in this since the 14th of July. I will probably keep this one rolling. Some of my other July trades I might just close just for accounting purposes for the end of the month. For our reports here, but that's looking you know, that's just, again, that was just a feel thing, not necessarily technical, not necessarily fundamental thing, just knowing that we could possibly, if it does come down, it could come down quite significantly. Sorry about that. I've got my Skype still on, so let me just get rid of that. So finally, before we close, Apple had a really good week. Facebook's having an even better week. Apple, everybody likes talking about Apple. Bounced off this triple bottom here down at 92. Great big jump up after their reports, back over key 100, back through the 23.6 Fibonacci was providing resistance. Had a go at it, fell away again back to 92. Had a go through it, leapt up through it this week. We'll see how this week finishes, and we'll take it from there. So that's all I'd like to talk about. Thank you for your time today. Time's nearly up, I think. Yes, I've run over a little bit. I tend to talk too much, but thank you for your time. I hope it's been useful. You know, if you want to take multi-time frame analysis further, we have some in-depth webinars, two-part depth webinars where I explain it much more slowly than I did today. But I say the key thing is trade with good risk management, trade with on your side. And many people ask me about books. I'm sure a lot of you that have traded here before will have heard of Jesse Livermore. If you only buy one trading book, buy this one. It's not necessarily a technical book. Well, it's not a technical book. I bought it many years ago. It's a great book, great insight. You know, he was worth $100 million back in the 20s. He made a fortune in the Wall Street crash. Made and lost a fortune two or three times. Couldn't get it back the fourth time, and unfortunately he ended up committing suicide. But fascinating character, great insight, and it follows me around. I always promise myself to read it once a year through my trading career. I've read it about 2 or 3 times, I think. But you know, written in 1923 by a guy called Edwin Levert. It's sort of the reminiscence of Jesse Livermore, but very, very well worth getting a hold of a copy. It's because it's out of copyright now, so it's a lot cheaper on the internet. You can get it as an ebook or a hard book. But you know, if you only ever buy one trading book, there's lots of books around, but this one's fascinating about you, because that's what it is. If you want to be successful, you've got to understand yourself, you know, and you've got to use real money, and you've got to learn, follow what you're doing, and study your mistakes, and get up and start again. Okay, so thank you very much, everybody. I hope it's been useful. I say email me directly at webinars@hotforex.com. My analysis is up here at analysis@hotforex.com. As I say, it's free. You don't even need an account with it. Just see how we do here, see how good we are at identifying our positions, and you know, add simple risk management to it, and it can be a very, very simple business. This. Okay, so thank you very much, and I appreciate your time, and look forward to seeing you again sometime. Okay, take care. Bye-bye.